Welcome to Tradewinx software. 1. Buy undervalued assets, buy low, sell high. If you're talking about stocks and other assets, you want to buy when the price is low and sell when the price is high. If you buy 100 shares of stock on January 1st for $5 per share, and you sell those same shares on December 31st for $7.25, you just made $225. That may seem a paltry sum, but when you're talking about buying and selling hundreds or even thousands of shares, it can really add up. How do you tell if a stock is undervalued? You need to look at a company closely, its earnings growth, profit margins, its P/E ratio, and its dividend yield, instead of looking at just one aspect and making a decision based on a single ratio or a momentary drop in the stock's price. The price-to-earnings ratio is a common way of determining if a stock is undervalued. It simply divides a company's share price by its earnings to determine how many times their company's earnings the price is. For example, if Company X is trading at $5 per share, with earnings of $1 per share, its price-to-earnings ratio is 5. That is to say, the company is trading at 5 times its earnings. The lower this figure, the more undervalued the company. 2. Invest in companies that you understand. Perhaps you have some basic knowledge regarding some business or industry. Why not put that to use? Invest in companies or industries that you know, because you're more likely to understand revenue models and future success. Of course, never put all your eggs in one basket, as this is highly risky. Wringing value out of an industry whose gears you understand will increase your chances of being successful. For example, you may hear plenty or positive news on a new technology stock. It is important to stay away until you understand the industry and how it works. The principle of investing in companies you understand was popularized by famous investor Warren Buffett, who made billions of dollars sticking only with business models he understood and avoiding. 3. Avoid buying on hope and selling on fear. It's very easy and too tempting to follow the crowd when investing. We often get caught up in what other people are doing and take it for granted that they know what they're talking about. Then we buy stocks when other people buy them and sell stocks when other people sell them. Doing this is easy. Unfortunately, it's probably the easiest way to lose money. Invest in companies that you know and believe in, and tune out the hype, and you'll be fine. When you buy a stock that everyone else has bought, you're buying something that's probably worth less than its price. When the market corrects itself, you could end up buying high and selling low, just the opposite of what you want to do. Hoping that a stock will go up just because everyone else wants it to is foolish. When you sell a stock that everyone else is selling, you're selling something that may be worth more than its price. When the market corrects itself, you've again bought high and sold low. Fear of losses may well prove to be a poor reason to dump your stock. Remember, if you sell based on fear, you may protect yourself from further declines, but you also miss out on the rebound. Just like you did not predict the decline, you will not be able to predict the rebound. Stocks have historically risen over long time frames, which is why holding and not overreacting to short-term swings is important.
Give us a call +9183910944408, www.stockbuysellsignal.com.